Welcome students to the lecture series of Financial Market and Services, and today is the third lecture of the money market. So, today we would be discussing about the three major instruments of the money market: the call loans, treasury bills and the certificate of deposit. So, when I talk about the money market, I told you in the last classes that what is money market, how is it different from the capital market, what are the components of the money market. So, call loan is one of the instrument. Now, money market is a market wherein we deal with the short term securities. Why there are different instruments in the money market? There are different instruments in the money market because of its features, because of its application, because of its tendency. We have different instruments where we understand that where we need to invest this money, from where can we get this money. So, call loan is one of the feature. So, the call loan is a feature wherein a lender can actually demand for the money at any point of time. So, if I am the lender and I am giving my money to anybody, I can ask for the money at any point of time, irrespective whether it is the maturity date or not. There is another term which is in relation to the call loan, which is the callable loan. Now, the difference between call loan and the callable loan is anything wherein the buyer can pay at any point of time. So, these are two different terms which cannot be used simultaneously or interchangeably. So, the first point says loan that a lender can be demand to be repaid at any time. So, the lender can pay this amount at any point of time. Second, call loans are different from callable loans, as the lenders can ask to repay at any time, where in the case of callable loans the buyer can pay at any point of time. Who is making these loans? The banks are making these loans to the brokerage firms. So, banks are actually involved in making the payment to the brokerage firms. Now, why do brokerage firms need this money? In order to finance their short term needs. If in case they are deficit of anything, if in case they need money only for few days, what they can do? They can go with the call loan option. The interest which is being charged on the call loan is known as the call loan rate. So, whatever amount that we are charging as an interest on the call loan is called as the call loan rate, and this call loan rate is generally 1 percentage point higher than the going short term rate. So, it is a bit expensive, but since it is easily available, we generally go for it. Now, what the brokers do, they may use the call loan. Why do they need this call loans? In order to buy the securities for their own house accounts. They want to buy anything from the market, they want to deal with any financial asset. So, in that case they would go with the call loan, and in order to purchase the securities for the underwriting purpose. Now, what is this underwriting? Underwriting is a sort of a guarantee which the broker gives to the other clients, other investors. Now, what is this guarantee? Guarantee is that if in case you fail to receive the amount, if in case somebody else does not make the payment, so broker gives the guarantee that I will make the payment. So, that is the main purpose of the underwriting purchases. The next thing that we really need to understand is whether the collateral is involved or not. So, collateral is involved in the cases of call loans. And what is this collateral? Collateral is nothing but just the securities which are kept in the cases of call loan. So, when I talk about the collateral, for any bank, for any organization, for any financial institute, collateral is something which actually helps in. So, if I fail to make the payment, if I do not have any amount with me, what will happen? My collateral can be used, my collateral can be forfeited, and when my collateral is forfeited, that can be used against the amount which I have borrowed. So, suppose if I have a house and I have taken a house loan and I fail to make the payment for my house, what will happen? My house will be forfeited. They will realize the money, the bank will realize the money from my house. So, that is the whole agenda of call loans, and call loans actually work in the same manner the other loans operate. So, this is the diagram that how the call loans actually work. So, the first thing is this is a broker will go to the bank and will ask for the money. Now, the bank will give the money. Now the broker has received the money. What the broker has to do? The broker has to present a collateral with it. So the money has been received by the bank. Now the broker will give the collateral. Now when the collateral reaches, to whom the collateral reaches? The collateral reaches to the bank. So this is money given by the bank, money received by the broker, the collateral against the money, and the collateral has been received by the bank. This is how the call loan operates. So what have we understood? That call loan is one of the instrument wherein you have the brokers and the banks which deal in. Why brokers need the money? In order to finance their in-house securities, in order to do the underwriting purchases. In such cases, the brokers go to the bank to meet their short-term liabilities, and if in case they need any money, what they do? They give a collateral against it in order to take the money from the bank. The next instrument that we are going to study in today's class is the treasury bills. So treasury bills are just the instruments. Again, it is a part of a money market instrument, so it is for the short term borrowings. And who issues the treasury bill? It is being issued by the central government. So the only party who can issue is the central government. Now it is being used by the government to manage their short term liabilities. So if in case the government has any liability, it will be used to manage those liabilities. Now the third point says that treasury bills are issued at discount and redeemed at par. So this is something which we need to understand, that what is the meaning of issued at discount and redeemed at par. So let us say if there is this treasury bill and the amount for this treasury bill is rupees 100. The moment it will be given, it will be issued, and the amount which it has been issued for is 98.20 rupees. At the time of issue, the person who is taking these treasury will only get the amount of 98.20. But when the maturity will end and when you have to make the payment, what you have to do? You have to make the payment of 100 rupees. And when you are making the payment of 100 rupees, what is this? This is the par. So this is the par value and this is the discounted value. So what have you done? You have issued at discount. Issued at discount means you have given it at discount, and redeemed at par means you have paid at par. And this par value is also called as the face value. Now what are the parties who are involved in it? So it is issued in primary auction, which is being conducted by RBI. So RBI is actually doing the auction process on behalf of the government, because we have studied that only central government can issue the treasury bills. So central government issue the treasury bills, and who is the authority which looks after it? It is the RBI who considers the auction of it. Moving forward, what are the qualities of the treasury bill? How important it is? Why do we need to buy a treasury bill? So first point is high liquidity. When I talk about high liquidity, liquidity means anything which can be easily converted into cash. So you have near cash assets, and when you are converting those near cash assets into cash in a very short duration of time, that is called as the liquidity. So high liquidity means it can be easily converted into cash. And the second is absence of risk of default. Since government is involved in it, it's a money market, so there are no chances of getting it default. What is the meaning of default? That obviously you would be able to make the payment. There will be no NPA. You don't have to deal with the category of defaults in such cases. Next point is ready availability. It is easily available. So it is not something for which you have to go to market and wait for a time that when it will come to the market and when can I buy it, what is the right time to buy it. No, nothing of that sort. It is readily available. So whenever you think that no, I have to buy a T-bill, you can easily buy those things during the process of auction. Next is assured yield. Since it's a government security, it is in the market, it have a assured rate of return. And what is that assured rate of return? So I told you 100 rupees bill has been issued at 98.20. So what is the return that you are getting? It is 1.80. So this is assured. It won't be 1.90 or it won't be 1.70, neither it can be 1.81. 1.80 is the fixed amount that you would be getting. So, there are no changes in that amount. Low transaction cost. Low transaction cost means the transaction cost, the way you deal in, the way you prepare your demat account and everything, for that the transaction cost is very less. So, when I told you that there are few disadvantages of the money market, I told you that there is this minimums and fees. What is minimums and fees? Minimums and fees is the amount that you have to pay in order to deal with it. In order to buy any instrument, in order to buy any security, what you do? You pay certain charges. So, when I talk about the low transaction cost means you have to pay very less charges when you are dealing with T-bills. Next is eligibility for inclusion in statutory liquidity ratio. So, there are different ratios that we have to maintain. So, first is CRR, which is the cash reserve ratio, and second is SLR, which is the statutory liquidity ratio. So, if there is any deficiency in your ratio, if you do not have sufficient funds, if banks does not have sufficient funds, what they can do? They can manage all those things from these treasury bills. They can take a T-bill and they can manage they can maintain their SLRs. Next is negligible capital depreciation. Negligible capital depreciation. What is the meaning of capital depreciation? So, when I talk about the currencies, in a currency, what is happening? In a currency, you have, say, my purchasing power of buying one mobile phone X is 30,000. So, I can buy this mobile phone of rupees 30,000 today. However, after 10 days, what is happening? This mobile phone has increased to the value of 30,500. Now, I am not in the capacity to buy this phone because the value of the mobile phone has increased by 500 rupees. So, when I talk about the T-bills, there is a negligible capital depreciation there. So, there won't be a difference of 500 rupees because it might be a huge amount for somebody. So, when T-bills are considered, if you can buy anything at 100 rupees today, the value may increase to 100.2, but there won't be a major change in the value. So, they do consider the differences when they are issuing it. The central bank's readiness to purchase and discount them. So, central banks are always ready to buy and to discount those things. The next thing, if I am interested in buying the T-bills, what should be the minimum amount that I need to invest in? So, the minimum amount that I need to invest in the purchase of the T-bills is 25,000. And it has to be 25,000 and it has to be in the multiples of 25,000. So, if a T-bill is of 25,000, it does not mean that I have to pay if I want to buy a T-bill, I can pay 25,003 rupees, or I can pay 25,005 rupees, or I can pay 25,010 rupees. No, 25,000, 50,000, 75,000, 1 lakh rupees. So, it has to be in the multiples of 1 lakh rupees. So, what have we studied in this slide? That T-bills are highly liquidable, they are easily available, the transaction cost is very low, there is a very negligible capital depreciation. So, it is not a major depreciation that you have to deal in this case, and the T-bills are available in the minimum amount of rupees 25,000, which you can only buy in the multiples of T-bills 25,000. So, there are 4 types of T-bills that we consider, out of which 3 T-bills are something which we can trade in. So, these T-bills are 91 days T-bills, 182 days T-bills and 364 days T-bill. What is this? This is the maturity time on the basis of which they have been categorized. How can we remember this? 182 days. So, if we will multiply 91 by 2, we would get this amount. If we will multiply 182 by 2, we can get this amount. So, it is very, very easy to remember that there are 3 types of T-bills: 91 days, 182 days and 364 days. The second point that we need to understand the difference between them is the periodicity. What is this periodicity? Periodicity means when can you issue them, when the government issues them, when is the auction taking place. So, for 91 days T-bill, the auction takes place on the weekly basis. So, every week you get a chance to buy these T-bills. For fortnightly, for 182 days, the auction takes place after every 15 days. And similarly for 364 days T-bill, the auction again takes place after 15 days. If I talk about 91 days T-bill, for the weekly, they take place every week on Friday. So, Friday is the day where they take place, and the transaction, the payment you have to make on Saturday. So, all these 3 work on T plus 1, which is the settlement time. So, if they are taking place on Friday, you have to make the payment by Saturday. If they are taking place on Wednesday, you have to make the payment by on Thursday. The second thing is fortnightly. So, fortnightly means every 2 weeks. Now, every 2 weeks there will be 2 Wednesdays. So, on one Wednesday the transaction will take place for 182 days T-bill, and on another Wednesday the transaction will take place for 364 days. So, over here it is written alternate Wednesday, leaving one Wednesday of this week and then taking place, then leaving the Wednesday, then taking place. However, in this case alternate Wednesday where the 182 days T-bill is not taking place. The fourth type of T-bill is the 14 days T-bill, and who can actually take these T-bills? The state government, the foreign central banks. So, these are the two authorities who can actually deal with the 14 days T-bill. The next thing, there is no periodicity. I told you periodicity means when can you actually buy these T-bills. So, in case of 14 days T-bill, there is no periodicity, there is no fixed time when they can take place. However, they generally take place on Friday. Not issue in competitive manner. So, there are two types of bids that take place in the case of a T-bill. First is the competitive bid, and second is the non-competitive bid. Now, what are these? What is competitive bid? What is non-competitive bid? This we need to understand. When I talk about a competitive bid means when there is a competition, when everybody is quoting their price and the person who bids the highest price will get those T-bills. When I talk about the non-competitive bid, there is no competition. So, which price do they consider? They consider the price on the basis of weighted average. So, the price is the weighted average of whatever the person is quoting. For PPFs, so you have public provident funds. For these agencies, what is happening? They can participate in both the markets. Both the markets means they can participate for the competitive bid also, and they can participate for the non-competitive bid also. Moving forward, there is no auction. So, in these three cases, what is happening? The auction is taking place. However, in the case of 14 days Treasury bill, the auction will not take place. Moving forward, how can you purchase T-bills? So, I told you that the purchase of T-bills take place with the help of the auction, and who is taking care of these auctions? NDS, Negotiated Dealing System, is taking care of this. So, it is an online platform, and who is managing it? The CCIL is managing it. CCIL means the Clearing Corporation of India is managing it. So, this CCIL is basically set up in order to see the transactions which are taking place, to see the trading, to see how things are happening. So, let us take an example. You have bid yield, you have bid price, you have offer price, and you have offer yield. This was something which was being bidded, which was 7%, and for this the price was 98.2847. However, the offer price is 98.2968. The person is offering a price. So, over here the person stands for the government. The government is selling the T-bills at 98.2968. However, an individual or anybody who is interested in buying those T-bills is bidding a price of 98.2847. So, this is the amount which they are ready to pay. This amount is less than what is being asked for, and since this amount is less than what is being asked for, there will be no transaction. No transaction will take place in this case, because offer price is more than the bid price and people are not ready to pay this thing, so there will be no thing. However, if in case somebody says that I will pay 98.2969, in this case this is higher than this offer price, the transaction will take place. And if there are multiple people who are involved in bidding the prices, so whosoever bids the highest price will get the T-bill. This was about the competitive bid. Competitive bid means wherever the competition is taking place, multiple people are quoting the price, and whosoever is bidding the highest price, and that highest price should be more than the offer price, the transaction take place. However, in the case of non-competitive bid, they take the weighted average method, and on the basis of weighted average method, whosoever is quoting the value less than this, the person will get the bid. So, it is on the weighted average method wherein the 14 days auction take place. The last instrument that we would be discussing in today's class is the certificate of deposit. So, certificate of deposit, why do we actually need this? So, certificate of deposit is just to extend the flexibility of the investor so that they can use their extra or surplus funds for the future benefits. So, certificate of deposit was introduced in India in 1989. It is a negotiable money market instrument, and it is being issued against the funds deposit at a bank or other eligible financial institutions. So, if you have your funds deposited in any bank, from there you can issue the certificate of deposits. Now, if I talk about the maturity period, for banks the maturity period is 7 days to 1 year. However, in the case of financial institutions, the maturity period is from 1 year to 3 years. So, who are the parties involved in it? The parties that are involved in the certificate of deposits are banks and the financial institutions. For banks, the maturity is 7 days to 1 year, and for financial institution it is 1 year to 3 years. I told you that who can issue? The scheduled commercial banks. Who are the scheduled commercial banks? Who are listed under the section 2 of the RBI Act. So, if a bank is listed under section 2 of the RBI Act, then it will be a scheduled commercial bank. Only scheduled commercial banks can issue certificate of deposits. If it is not a scheduled commercial bank, then they cannot issue certificate of deposit. So, RRBs cannot issue it, local area banks cannot issue it because they are not scheduled, they are not under section 2 of RBI Act. And any financial institution which has been approved by the RBI can issue this. So, one of the example is IFCI. You have IFCI who is actually dealing with the issue of certificate of deposits. The next thing is the minimum amount that you need for this. So, I told you that in case of T-bills the minimum amount is 25,000. However, in the case of certificate of deposits, the minimum amount that you need is 1 lakh rupees or anything in the multiples of 1 lakh. So, it has to be 1 lakh, 2 lakh, 3 lakh, 4 lakh. No amount like 1,50,000, no amount like 1,75,000, no amount like 1,80,000. It has to be in the multiples of 1 lakh. So, these are few other details of certificate of deposit. So, the first thing is deposit a certain amount of money. Okay. So, this is very easy. You just have to deposit a certain amount of money. There will be a maturity. For banks, the maturity is 7 days to 1 year. For financial institutions, the maturity is 1 year to 3 years. We won't be working on the financial institutions because we are discussing about the money market, and money market clearly talks about the short term liabilities, short term assets, and short term means anything which is less than a year. So, you just have to wait from 7 days to 1 year. Now, you have waited for 7 days to 1 year, you would get your amount. So, whatever amount plus your interest rate, you will get the amount. The second thing is guaranteed rate of return. Since it is a money market instrument, the returns on certificate of deposits are guaranteed. So, you do not have to pay, there is like no dilemma that whether I would be able to get the returns or not, or what should be the rate of returns that I would be getting if in case the market does not well, so whether I would be able to earn the returns or not. No, there are fixed rate of return, there are guaranteed rate of return, you do not have to worry about it. Next advantage of a certificate of deposit is it's offer a higher rate than savings. So, whatever amount you are keeping in your saving bank, definitely in the case of certificate of deposits you would be getting a higher rate of return. And when you are getting a higher rate of return, it is better to invest in savings. But with that, there's one few disadvantages also of using the certificate of deposit. So, the first disadvantage, the first con of using the certificate of deposit, it can be liquidated as early withdrawal triggers penalty. So, on the case, if in case you are not able to keep the money for a maturity period, suppose you have decided the maturity of 3 months and in between you are in need of money. Now I need money, but I cannot take my money back, because if in case I take my money back, what will happen? I would actually get the penalty, I would be charged for it, and when I am charged for it, what I have to do? I won't be able to invest in that particular fund. But this is an advantage also. How this is an advantage? Because you would be able to keep your savings in your bank. With this thing, that you have a forced thing that you have to keep your savings, so your savings will be there even after 3 months. So, you won't be able to take the savings out. So, you won't be able to attract the penalty. Less rate of return than stocks or bonds. Definitely it earns the higher rate of return in comparison to your savings bank. So, if the saving is giving the advantage of 3.5%, 4.5%, you will definitely get a higher rate of return on it. But the rate of return that you would be getting in certificate of deposits is definitely lesser than what you are getting on your stocks or bonds. We discussed that one of the advantages is the guaranteed rate of return, which in turn is one of the disadvantage also. Because since you have a fixed rate of return, what is happening? Just because you have a fixed rate of return, you are not dealing with the fluctuating rate of returns. And when you are not dealing with fluctuating rate of returns, you may miss out on an opportunity to earn higher rates. You may miss out an opportunity to earn a return of maybe 10% or 12%, wherein you are earning only 5% of return on certificate of deposits. And how this is an advantage? Because there will be a case also where suppose the rate is for certificate of deposits is 7%, and in the market the rate of return is 12%. So, this is for certificate of deposits, this is for market. Now, this is the fluctuating rate of return, because in the market we consider the demand and supply of money, and when the rates are determined on the basis of the demand and supply of money, it may increase and it may decrease. If suppose this value turns out to be 2% or 5% or anything lesser than 7%, then what is happening? You are actually incurring losses. So, in order to avoid that incurrence of losses, what will happen? That will become an advantage for you. So, there are 3 types of people who are ready to take the risk. So, when I talk about the 3 types of people: risk seeker. Risk seeker are the people who are ready to take the risk. They may see that okay, the rate may decrease, the rate may increase, so I am ready to bear it. Risk neutral, who are neither inclined on taking the risk, neither inclined on not taking the risk. And risk averse. Risk averse are the people who are not ready to take the risk. They have a complete no, a big no to the risk. So, for them it is a good instrument where they can invest in. So, in today's class we have studied 3 things, 3 instruments: call loan, treasury bills and your certificate of deposits, wherein I told you that 3 of them differs from each other. Call loan, you have to keep a collateral, and the banks and the brokerage firms are involved in it. When treasury bills are considered, you have 4 types of treasury bills: 91 days, 182 days, 364 days, wherein you can deal it, and the 14 days treasury bill where the state government on the foreign investors can deal it. And next is your certificate of deposit. Certificate of deposit for which the minimum amount is 1 lakh rupees. You have to wait till maturity. If in case you don't wait till maturity, what will happen? You will be attracted towards the penalty, and when you have to pay the penalty, what will happen, you won't be able to earn a good rate of return. So, if in case you can wait till the maturity, then certificate of deposits are fine. In the next classes, we would be discussing about other instruments of money market and what are the recent trends, recent changes that are taking place in the money market. Thank you.